Hi everyone. We're working on chapter 10 finally, moving down the balance sheet. This is the last section of the balance sheet that we are covering, the stockholders' equity section. Next chapter we will do cash flow statements and then financial statement analysis, and we're finished. So the stockholders' equity section. Remember the accounting equation, assets equal liabilities plus stockholders' equity. We're going to focus on this piece over here, stockholders' equity. Paid-in capital is a component of stockholders' equity. It's the amount the stockholders have invested in the company. And retained earnings is the other piece. So the paid-in capital are things like common stock. Retained earnings we already know about. This is just a review. It's the amount of earnings the company has kept or retained over the life of the company that they have not distributed to shareholders in the form of dividends. We will talk about something called treasury stock. So there's three pieces here: paid-in capital, retained earnings, and treasury stock. Treasury stock is a company's own stock, the issued stock that's out there that it repurchased for use internally. And we'll do that in more detail in a bit. Remember, if you look at an organization chart, a lot of times you'll only see from the CEO down. But what you need to remember is a public corporation is owned by stockholders, so they're at the top. So we will discuss stockholders and their rights. First, they have the right to vote on matters, including election of the corporate directors. They also have the right to receive dividends. This does not mean the company has to pay dividends, only that the stockholder has the right to receive dividends. They have a right to share in the distribution of assets. If the company is dissolved, after all debts are paid, whatever's left gets distributed to the stockholder in the percentage of ownership that they hold. And we talked about this at the beginning of the semester, advantages and disadvantages of a corporation. The advantages of it is that it has limited liability, and it's easy to raise capital and transfer ownership. You raise capital by selling stock. You transfer ownership by selling stock. There are disadvantages, and we talked about this at the beginning of the semester too. Additional taxes. Corporate earnings are taxed twice. And there's a lot more paperwork involved in a corporation. So, types of common stock. There are three types: authorized, issued, and outstanding. And this is critical that you understand this, or you won't be able to do any of the problems in the homework. Authorized are the number of shares available to sell. In other words, what did they set up in their corporate charter? Those are the authorized shares. All of the shares of a company are authorized. Issued are the ones that are actually sold. Outstanding are shares issued that are out there and held by investors or stockholders. And treasury stock are shares issued and repurchased by the company. So authorized, issued, outstanding, and treasury. Treasury stock has already been authorized and it's already been issued. It does not ever become unissued. So here's a graphic that kind of helps you. All stock is authorized. There's a portion of it that may not be issued yet. And of the amount that's issued, it's either still outstanding or it's owned by the company in the form of treasury stock. And we will be talking about par value. What you want to remember is, well, we'll get to that. Par value is the legal capital per share of stock that's assigned when the corporation is first established. When they establish it with the Corporation Commission, you set up how many shares of stock you're going to authorize and what the par value will be. It has no relationship to the market value, and that's what this slide is about, the market value. I actually pulled this information from Cap Genius. The only thing that par value really matters is how much you have to pay for your founder stock. So if you authorize 1,000 shares of stock and the par value is $1, you can buy 500 shares for $500 as a founder of the company. However, if you set the par value at $1,000 a share, you're only going to get one share for $1,000. And that does not give you ownership, 51% ownership of your company. So I've given you a link here and you can read about this on Cap Genius. Preferred stock, that's a type of stock. Preferred stock can be convertible, it can be redeemable, it can be cumulative. Mostly we're going to talk about preferred stock that's cumulative. If preferred stock is cumulative, that means that anytime you issue stock or issue dividends, you have to pay preferred shareholders first. So for this company, they didn't pay dividends in 2019 and 2020, and they're going to pay dividends in 2021. First, they have to go back and pay the dividends for 19 and 20 to preferred shareholders, then pay 21 to preferred shareholders, and then what's left over goes to the common stockholders. If it's non-cumulative, you don't have to go backwards, but you do have to pay the preferred first in the year that you authorize dividends. Let's do some examples. We have 3 examples I want to do. And you'll have this Excel sheet. In addition, all of your group work are actually these problems. So I've set up your group work to be these problems. What I would recommend is that you follow through with the examples, excuse me, and then you try to do the group work without looking at the solutions, because that'll give you the practice you need. So they're talking about Gothic Architecture issuing 1,000 shares of $1 par value common stock at $30 a share. We're asked to record the issuance of the stock. When a company issues stock, it actually gets cash. In this case, they're going to get 1,000 shares times $30. So they're going to get $30,000. And it's common stock, so it's going to go in the common stock account. And that's a stockholder's equity, so you increase it by crediting it. The difference here, instead of just crediting $30,000 to common stock, we're only going to put par value in the common stock account. So the par value is $1 per share, so it's 1,000 shares times $1. The difference between these two, the 30,000 minus the 1,000, goes into another stockholders' equity account called additional paid-in capital. So we only record par value in the common stock account and in the preferred stock account. The additional amount they paid goes into an account called additional paid-in capital. How would the entry differ if Gothic issued no par value stock? So there can be a par value stock, there can be a no par value stock. And just to confuse matters further, if it's no par value, the board of directors can attach a stated value to it. The difference would be we would just debit cash and we would credit common stock. There would be no additional paid-in capital, and it would all be $30,000. So remember, par value only in the stock accounts. This one, Equinox Outdoor Wear, issues 1,000 shares of his 1 penny par value preferred stock for cash at $32 a share. So how much cash did they get? Well, they issued it for $32 a share. So 1,000 shares times 32, or $32,000. And it's preferred stock, so it goes in the preferred stock account, but it only goes in at par value. So 1,000 times 0.01, 1 cent per share, or $10. The difference, 32,000 minus $10, is 31,990, and that goes into additional paid-in capital. So it's fairly simple. Just remember, only par value in here. Everything else goes to additional. One more. BE 10-7. So Rachel Design has 2,000 shares of 7%, $50 par value cumulative preferred stock issued at the beginning of 2019. All remaining shares are common stock. Due to cash flow difficulties, the company was not able to pay dividends in 2019 or 2020. They plan to pay dividends, total dividends of $23,000 in 2021. How much of that $23,000 will be paid to preferred and how much to common? So, preferred dividends in arrears for 2019 and 2020. So they have to go back and pay the preferred shareholder. So we need to figure out the preferred dividends per year for this. Preferred dividends are calculated by taking the number of shares, $2,000 or 2,000 shares, times 0.07 or 7%. So that's 140. The 140 times $50 or 7,000. So it's 7,000 per year on the preferred dividends. If it's in arrears for 2 years, it's 7,000 times 2, or 14,000. And then preferred dividends for 2021 would be 7,000 because it's 7,000 per year. Let me just not split this up because we don't have to worry about order of operations. So 2,000 times 0.07 times 50 is 7,000 per year. We have a total of 23,000. So how much of it goes to common shareholders? Remaining dividend to common shareholders. So 23,000 minus 14 minus 7, that leaves 2,000 for the common shareholders. The total dividends were 23,000, like they said in the problem up here. So if you have preferred dividends, that's a preferred stock that's cumulative, you have to go back and pay each year's dividends and pay the current year's dividends before you can give common shareholders dividends. Okay. Let me go back to this. So what does that look like on a balance sheet in the stockholders' equity section? They typically list the stock, preferred stock, how many shares are authorized, how many shares are issued, and how many shares are outstanding. And they list a par value. You can calculate how many shares this is because we know that only par value goes in here. So we could take the dollar amount and divide it by the par value and find out how many shares it is, if they didn't tell us. Tells you common stock, how many shares are authorized, how many shares are issued and outstanding. And then additional paid-in capital. Gives you a total paid-in capital, add your retained earnings, and that gives you total stockholders' equity. Treasury stock. So companies buy back their own stock for different reasons. They may want to boost underpriced stock by trading in the market on it. They may want to distribute some surplus cash, but they don't want to pay dividends. So they could buy back their own stock and reissue it again later. They may want to boost their earnings per share. Earnings per share are calculated on the outstanding shares. So the earnings per share would be higher if there were less shares outstanding. And to satisfy ESOP, or employee stock ownership plans. If they want to gift stock to employees, they have to have it to gift. So they have to buy it back if they don't have any. So when a company purchases treasury stock, it does not affect the stock accounts. It affects additional paid-in capital and an account called treasury stock. Treasury stock is a contra stockholders' equity. You debit it to increase it instead of crediting it to increase it. So if they purchase treasury stock, this is what it looks like before they purchase it. And this is what it looks like after they purchase it. It reduces total stockholders' equity, but it does not change your stock accounts because stock cannot become unissued. You can repurchase it and it may not be outstanding anymore, but it was still issued at par value. And if treasury stock is sold, so here before the sale, and then after the sale, and we'll talk about that. We'll go through the mechanics of that in these next two problems. Oops, wrong sheet. Okay. California Surf issues 1,000 shares of $1 par value common stock at $35 a share. So they did that. And then later in the year, they decide to purchase 100 shares at a cost of $38 a share. Record the purchase of treasury stock. Super simple. Debit the treasury stock account and credit cash. And we purchased it for 100 shares and we paid $38. So $3,800. When it becomes complicated is when they resell the 100 shares, but they sell it for more than they purchased it for. You can only take back out of the treasury stock account at the amount per share that you put it in at. If I put it in at $38 a share, I have to take it out at $38 a share. So if I resell it, I'm getting cash. 100 shares times $40. I want to reduce the treasury stock account, but I want to reduce it by the amount per share that I put it in at. I put it in at $38 a share. I'm going to take it out at $38 a share. So 100 shares times 38. The difference goes to additional paid-in capital. Which is the $2 per share, right? Or the difference between these two. $2 per share because we sold it at 40, we purchased it at 38, so it's 2 times 100. Just remember, when you resell it and you take it out of the treasury stock account, it comes out at the same rate you put it in there for. Okay, And we're going to do a comprehensive example here. Nautical has two classes of stock authorized, $10 par value preferred and $1 par value common. As of the beginning of 2021, 125 shares of preferred stock and 3,000 shares of common stock have been issued. And then they have these transactions in 2021. The most common mistake students make is they forget the beginning balances. So on March 1st, they issue 3,000 additional shares of common stock for cash at $10 per share. So cash, 3,000 times 10. The only amount we can put in the common stock account is par value. Par value for stock is $1 par value. And if it's 3,000 shares times $1, that's $3,000. The difference goes to additional paid-in capital. April 1st, issue 175 additional shares of preferred stock for $40 a share. So 4/1/21. Oops, I think I'm going to skip a line here. 4/1/21. Cash, $175 shares times $40, or $7,000. Preferred stock, par value is $10 a piece for preferred stock. So 175 shares times $10. The difference goes to additional paid-in capital. June 1st, we're declaring dividends on both common and preferred stock of 25 cents per share to all stockholders of record on June 15th. Let's just flip back over here and let's talk about, no, let's not. Let's keep doing this. So we need to know how many total shares there are because we have to multiply it by 25 cents per share. We're just declaring the dividend, and we have to have a date of record, and we call that date of record June 15th. In this case, that means all stockholders that own stock on June 15th will get a dividend. We're declaring it, we're not actually paying it yet. When we declare a dividend, we debit dividends and we credit dividends payable. That's when the company becomes legally responsible for it. So how many shares do we have? Well, let's just calculate here. Because we started with some. So we started with 125. Oops, let me just do it down here by the dividends. We started with 125 and 3,000. And then we issued an additional 3,000. And we issued an additional 175. So we have 6,300 shares. And we're paying 25 cents per share. So $15.75. On June 30th, we're paying the dividends that we declared on June 1st. So we're debiting dividends payable and crediting cash for $15.75. because now we're paying it. August 1st, purchase 175 shares of common treasury stock for $7 per share. Okay, this was August 1st. We're purchasing treasury stock. We're going to debit treasury stock for 175 times 7, or $12.25. And we're going to credit cash for that amount because we had to pay for it. October 1st, we resell 125 shares of that treasury stock for $9 a share. So we're reselling on October 1st. And we're getting cash. We resold 125 shares at $9 a share. How much can we take out of the treasury stock account? Well, we put it in at $7 a share, so we can only take it out at $7 a share. So 125 times 7, or $8.75. Let me just copy this, or let me format this. Okay, the difference goes to additional paid in capital. 1125 minus 875, or 250. The key thing to remember in these problems is to be sure to read up here if you have any shares at the beginning of the year before you started doing other things. All right, let's go back to our slides. So retained earnings. If you remember back to chapter 2, maybe, 1, I think. Retained earnings are all the earnings that are retained in the corporation and not paid out as dividends. If you remember right, the retained earnings started out as beginning retained earnings plus net income less dividends equals ending retained earnings. And that's critical for you to remember in this chapter. And retained earnings, you don't ever zero it out. All net income minus all dividends over the life of the company. And it can be a negative number. That's called a deficit. Lots of deficits going on in this economy. And cash dividends. So we kind of jumped ahead and did a problem with cash dividends, and now we'll talk about it really briefly. It's the distribution by the corporation to the stockholders, which I'm sure you already know. This is a review. Not all companies pay dividends. There are 3 dates you need to be aware of. The declaration date. This is the date which the board of directors declares the cash dividend to be paid. Record date is the specific date the company will determine who receives the dividend, because if stocks are traded on the open market, you have to pick a date. And then the payment date. The only dates that have journal entries on are the declaration date, and that's where we did the debit dividends, credit dividends payable, and the payment date. That's where we debit dividends payable and credit cash when we actually pay it. There's no journal entry on the record date. It's simply, that's the date we determine who gets it. And we already did some recording of dividends. Declaration date, debit dividends, credit dividends payable. Payment date, debit dividends payable, and credit cash. Try to say all that fast. So, stockholders' equity section. As a review, this is what we covered in this chapter. Preferred stock, common stock, additional paid in capital, total paid in capital, retained earnings, treasury stock. Our statement of stockholders' equity now looks like this. We've added, just instead of common stock, we've added preferred stock. We still have our common stock. We added additional paid-in capital, retained earnings, and treasury stock. And remember, read these in columns, not rows. Last example is this one. Okay. This is the stockholders' equity of the 70s shop. What I want you to first look at is, this says in thousands. That means all of these numbers need to have 3 zeros added to them. Oops, I think I have the wrong one open. Let's open the one without the solutions so we can work through it. And we have to answer questions based on what we see here. How many shares of preferred stock have been issued? So if we look at the preferred stock, it has 0 on it. So 0 shares have been issued. How many shares of common stock have been issued? Well, there's 20,000 in here, and if it's $5 par value, we should be able to take the 20,000 and divide it by 5 and come up with it. However, this is in thousands, so we need to add 3 zeros. So plus 2 0 0 0 0, and then another 3 zeros, and we're going to divide by the par value of 5, which gives us 4 million shares. You can actually just take 20,000 divided by 5 and then add 3 zeros to it. In any case, the final answer needs to have that extra 3 zeros. Total paid-in capital is 120 million. See this? Total paid-in capital 120 million, because it's 120,000 plus 3 zeros. At what average price per share were the common shares issued? Okay. So if the total paid-in capital is 120 million and 120 million divided by the 4 million shares, that should give us our answer, right? 1 2 0 0 0 0 0 0 0 divided by the 4 million gives us $30 per share. If there had been some preferred stock, we would have had to pull out the preferred stock issue price in order to arrive at the common stock issue price. 4. If retained earnings at the beginning of the period was 45 million and net income was 9,907,500, how much was paid in dividends for the year? Well, we want to look at this. So retained earnings, let's say beginning retained earnings, and they told us that was 45 million. 1 2 3 1 2 3 45 million. Add net income, that was 9,907,500 less dividends, we don't know what dividends was. That's what they're asking us. How much was paid in dividends? Equals ending retained earnings. We do know ending retained earnings because we have it here. It's 53 million. Remember, 53,000 plus 3 zeros. So now we just solve for x. 45 million plus 9,907 minus x equals 53 million. So when you solve for x, you move x across. Anyway, once you solve for it, the dividends paid for the year are 1,907,500. And you could put this in here and make sure that it all added up. If the treasury stock, oh look, we have treasury stock in here as a negative, remember it's a contra equity, was purchased for $20 a share, how many shares were purchased? Well, all we have to do is take the 3700 plus 3 zeros, oops, and divide by the $20 a share. And that gives us 185,000 shares. How much was the dividend per share? The formula is dividends divided by outstanding shares. Well, first we want to calculate outstanding shares. And we already have dividends. We calculated that in number 4. So outstanding shares means the shares that are out there, how many are still out there? Well, we had 4 million out there, but we repurchased 185 of them, so they're not outstanding anymore. So this are my outstanding shares. Not 4 million, but 4 million less the amount that we repurchased. The formula is dividends divided by outstanding shares. So my dividend per share is 50 cents. And that's actually it for chapter 10. Remember, all of these problems are your group work problems. I'm going to post a blank sheet for you to work through this with the video and put all of your own solutions in. And you can obviously replay the video as many times as you like. Try to do the group work without, oops, I cut myself off. Try to do the group work without looking at the solutions. Have a good weekend. I will see you on Tuesday.